So portfolio management, this is something this is a subject that I get a mixed reaction to sometimes. I talk about it on a regular basis, and the reactions they tend to kind of cover the spectrum of between, oh, this is great, this answers a lot of questions that I had, or this is very useful, to the other side of the spectrum of yawn. This is a little boring. All I want to do is just make 10 pips a day on my total account, and I'll be able to retire in a couple of years. So you can kind of tell what kind of traders I'm referring to in both of those reactions. But portfolio management is something that I'm pretty passionate about, and it's something that I feel like, to give you a little introduction, there's a reason why institutional managers and professional managers spend so much time uh, analyzing their portfolio, balancing their portfolio, etc. And the retail investor has a lot of advantages, but I find that one of their disadvantages is education about what's available to them. What other assets do they have at their disposal that they can use to their benefit in the same way that an institutional investor does or a professional manager does, because they don't just do that for their own health. And of course, so understanding a little bit about how portfolio management can benefit you is very, very helpful. I'm gonna switch to the next slide. So one of the first things I wanted to do is just talk about some of the issues that I've seen traders, retail investors deal with. And when I say this, here's how I'm classifying essentially a retail trader, and to a certain extent, to maybe to a lesser or a greater degree, a lot of us have probably fallen into this definition at some point in our career. And so when I'm referring to this, here's what I see happen a lot is I'll see somebody who's very ambitious, very intelligent, and they want to take control of their investing. So they begin to get educated. And let's say they decide to participate in the best market out there, the forex, and they'll get out there and they'll start to trade, and they may even start to see some success, but they start to struggle because they may have a portfolio of X size, and it's hard to get that capital utilized or deployed. So a lot of traders will fall into a trap of they'll start investing too much because they're trying to utilize as much of their capital as possible. So they'll push too much into single trades because they can't manage 100 different trades at a time if they're using very small money management or trying to constrain their risk. It also creates problems with, if you specialization within a specific market can create systemic risk exposure. And what that means is this is how a finance professional would define that. Is that it's the kind of risk that you're exposed to that would affect the whole market that you're involved in. So, in other words, yesterday and today, I think are great examples of that kind of risk where the market kind of all across the board reversed and the dollar began strengthening, and then again reversed today, and zooming right back up again. It's interesting. One of the things that I monitor quite a bit, and that I discovered a few years ago, was I would watch our web traffic. We operate a content site where we put commentary and videos and things like that, and I'll watch traffic on the site. So, and we'll survey people, and talk to traders and etc. And anytime the market gets really crazy, either to the upside or the downside, it really in the forex it really doesn't matter. Anytime it just gets really volatile, you see your traffic numbers just go way down. And I've talked to my peers in the industry, and we all essentially see the same thing at the same time. Well, what is that? What's causing that? And why do I bring it up? I always call it it's my site sentiment indicator. And as we've talked to traders, it's because they're experiencing a lot of volatility within their portfolio. And more often than not, as we quiz them a little bit, it's generally their portfolio could be defined as something that is very, very specialized. So they may be in many times they're in essentially the same trade, even though they think they're diversified. So they may be long the euro dollar and simultaneously short the dollar franc. Now I know that's a very simplified version, but there are a lot of that. I would say one other example of that, I think, in fact, the most classic example in my opinion, are it grates on my raw. It makes my nerves a little bit raw when people classify the carry trade as anything crossed with the yen. So as some of you know who go check out, I manage a portfolio, a carry trade portfolio, and I disclose what we're doing in that portfolio on the site. And that's definitely not the way. In fact, we have a 1/6 exposure to the yen. Period. So it's that's kind of the issue, is that specialization can create that risk exposure where everything seems to go bad or everything seems to go good at the same time, and that creates volatility. Finally, the last thing I would mention is that specialization or trading exclusively, it creates a problem of measuring performance. And I'm going to get into a little bit more detail on this, but it really, I guess I would say, is compared to what? How do you know that your trading, your activity on your portfolio is actually benefiting you versus hurting your performance, what you could get, from a commercially available manager? So it's an important question to ask, and it's an important question to understand how to evaluate that on a regular basis. And I have a couple of tips today. One of the things that I'm going to do as we get into our discussion today and start going through the benefits and some of the solutions relative to portfolio management is I'm going to talk about some very specifics. However, you don't have to copy this. I decided to do some very specific examples because I wanted to provide some context. But the principles are they're modifiable depending on what really suits you and your investing strategies and your own risk profile. But let me go over some very basic general benefits of what portfolio management really gives you. Number one is that it provides a framework for you to develop objectives, strategies, goals, etc. And so it gives you a more holistic view of what is it exactly that you're doing. So, for example, I find that oftentimes retail traders will measure risk exclusively by their stop loss, and which is probably an insufficient way to measure risk in your portfolio. Whereas, because that's pretty much exclusively constrained to that specific trade. Measuring risk is important to understand how that applies to your whole portfolio in general. And when I say whole portfolio, what I'm really getting at is this second bullet item here, which is a general market awareness. The idea is that oftentimes we may get a little bit, I call it trader myopia. Myopia is tunnel vision. So it's where it's a disorder where all of a sudden your eyesight your peripheral vision begins to erode, and you begin to see out of tighter and tighter uh, circles of vision. Excuse me. Excuse me. You begin to see out of tighter and tighter circles of vision right in the middle of your eyes, and you lose your peripheral vision, and things can come out of the that you don't see normally and hit you unexpectedly. Whereas if you had been aware of X risk or Y risk in another market, you may have been able to take better advantage of that. One of the things that I talk about quite a bit is intermarket analysis, and that's where this comes from. So, for example, when you hear people talking about, hey, you can look for trading signals on gold indexes to trade the Australian dollar, or you can look at changes in the TNX or the 10-year yield in the US to identify periods of risk or an unusual or a likely movement that may be unusual on the dollar franc. That's really what we're talking about, is that when you try to apply portfolio management by spreading your risk, not only diversified within the market that we're all obsessed with, the Forex, but throughout the market. So into the stock market, bond market, etc., and I have some examples to show you exactly what I mean, then it creates this awareness where you lose that tunnel vision and you become much less preoccupied with what's only going on exclusively in your market, and you become much more aware for where is the news really originating, what's really going on, even if that's the stock market, the bond market, commodities, etc. So there's three things that I'm going to talk about specifically that can be used to improve portfolio management in general. And what I would encourage you to do is, obviously the format today is too brief for us to do a really comprehensive discussion on what is portfolio management. There are hundreds of books written on the subject, and so I'm going to go through three very, very key points. And then if you would like to know more or want a reading recommendation or anything like that, you're more than welcome to send me an email. I put my email there on the beginning of the discussion, but before we end today, I'll chat it in the Hotcom room here. But we're going to be talking about diversification a bit, money management and position sizing, and I have a pretty good example for this, and then benchmarks and performance analysis. So how might we approach that? And I have to preface this a little bit with saying that, look, you're going to be getting a peek inside of John Jagerson's portfolio. This is not necessarily what everybody's looks like or should look like necessarily, but the basic concepts are pretty sound and can be modified to suit your own investing requirements. So let me talk about the first thing, which is we're getting into diversification. And diversification is oftentimes referred to as basically the only free lunch you'll ever get from the market. It's really the only one of the few things you can do that doesn't hurt your returns, but in fact, but does still help control your risk. So there are very few things that do that. So I mean, I think the classic comparison would be a stop loss. Now we all trade with stop losses. I recognize how important they are. We all may treat them very differently as to how we set them and how tight, etc. But the one thing that we'll all agree with is that stop losses, regardless of how you set them, once in a while, your stop loss gets hit even though your analysis was ultimately correct. So we trade off some return we know that whipsaws are going to occasionally get us out of our trade, but we're willing to give up that for the safety or the removal of a lot of risk. When the market doesn't whipsaw, in fact, just goes against us considerably. Well, diversification really doesn't have a lot of drawbacks. And one thing that I would mention is that it helps to solve that problem of asset allocation and capital utilization. So the issue, and I would be curious as to how many people fall into this category. I've ever experienced this problem where I get a lot of emails where people are saying, well, what do we do with I found a couple of good trades that I like, but I don't see anything else, right now in the market that I'm really interested in. What should I do with the rest of my money? Well, this helps answer that question, because ultimately how much time and effort we're able to actually spend in deploying that capital may really constrain how much we have deployed at any one time. It smooths the equity curve, which just means you have less volatility in your overall portfolio, and I'll show you a couple of examples here in just a second on the charts as to what exactly do I mean by that. And then, of course, you can adjust this for risk tolerance. So let me show you how I allocate my portfolio. So I have, in my example, I have 25% of my portfolio in equities, and which are, they're considered a growth investment. Excuse me one second. Excuse me. So 25% in equities. In general, that's usually a blend between U.S. domestic equities. So, you could consider the S&P 500 or something like that, although I spend more of my time just looking for good growth stocks. And international opportunities. So international investments, which lately have, despite the credit crisis, have been surprisingly durable. Another 20% in cash and 90-day treasuries. So, and which again is something that you can, is fungible. You can change this, obviously. The yeah, thanks a lot, Luca. The so one of the reasons why I leave cash available is because it's helpful for when you have to exercise a little bit more risk control than you might otherwise. So, for example, when the market gets really crazy like it is right now, I'm still long the commodity currencies. I mean, I've been saying for over a month now that there's a lot of risk concentrated in the commodity currencies, but that doesn't mean that I've actually gotten out. In fact, I'm still in because it's part of a carry trade portfolio that I manage, and nothing has scared me off quite yet. But there is a lot of risk there, and I can take some of this money that's been left in cash to provide some hedges, either through options or whatever it is. The reason why I mentioned 90-day treasuries is that depending on the brokerage that you use, you can talk to them about cross collateralization, and it is possible in many cases to use treasuries as margin, so that you can be earning that return. Finally, 25% in my case in forex strategies, and I provided one here as just an example. This is a DBV. This is something I've talked about. Most of you have heard me talk about this before. It's the carry trade. It's a version of the carry trade done by Deutsche Bank, and I have a strategy that's similar to this, and so I use it as kind of a reference here. And then another 30% fixed income bonds, etc. So let me show you an example of exactly what I mean. We're going to jump onto the charts for just a minute here. So I'm gonna stop sharing my PowerPoint here and flip to my charts. Okay. So you should see my charts by now, and I actually have the dollar yen up, and because I just thought it was a great example of something that's been reasonably volatile here over the last little while, including the last 2 days. So the dollar yen, and obviously a lot of us are trading the dollar yen long or short. There's probably a pretty even blend these days, and but we all recognize that we're exposed to this systemic risk that exists in the forex of the market is basically being pushed around considerably by sentiment. So yesterday, for example, this is yesterday's candle right here. And that, of course, the market was basically, there was a bit of a short squeeze as all these yen shorts were trying to buy back their yen trades, as the risk environment appeared to be getting more risky. And so the market gets a little crazy and begins to go down. Well, there were a lot of us who, and this is just an example, there were a lot of us who were looking at the dollar yen, and we'd seen this little inverted head and shoulders. So shoulder, head, shoulder, finally got the break on the 7th. And so a lot of traders were taking a discretionary position to the upside. Well, not only was the dollar yen going down, but what else goes down when the dollar yen goes down? Well, equities do, clearly. So I mentioned that when I'm looking at allocating my portfolio, one of the reasons why I do that is that I'm looking for a smooth equity curve. And if I have, all of my investments tied up in, let's say, equities, long equities, or a long position on the dollar yen, then my whole portfolio is going to be basically moving as though it were a single trade, which is one of the reasons why I take that outlook on across my portfolio, that it makes sense for me to push assets into other asset classes so that I can see these kind of benefits. So I'm going to change the view here. I'm going to be looking at the IEF. So this is this is a very interesting little fund that actually tracks the return of the 7 to 10 year T-bills. Okay. And I'm going to zoom out here just a little bit so you can get a better view. But you'll notice, by the way, a very important candle yesterday. So yesterday, I'm kind of losing my shirt a little bit in equities, and to a certain extent in some of my forex trades, where the market just kind of reversed on me. No big deal, but it happens. And at the same time, I've got my treasuries fund, my bond fund, is appreciating considerably as yields drop. So I have that kind of an opportunity. Now you'll notice, and one thing I want to point out, and I always like to to be very, very specific about the examples that I'm showing. So once again, I just want to repeat that it's not necessarily a recommendation, and you don't have to use the same kinds of strategies that I do. What I'm using this for is to illustrate a point. You'll notice that since 2007, by the way, I'm just going to draw a little line here. So there's the open of 2007. So over the year, the IEF has improved about 5%. It's returned about 5%. That's with no leverage. And in the Forex, we know all about the power of leverage. We know what the kind of value that offers. But for 5%, that doesn't sound like a whole lot until you consider that that doesn't account for the yield. Well, bonds yield. Which means that it's basically paying you a dividend. And in fact, this particular fund pays a dividend of about 4.5%. So, currently that's where yields are on that portfolio of 7 to 10-year treasuries. So you're on an unleveraged basis, you're basically at a 10% return over this year. That's helped to offset and stabilize a lot of the issues that I've experienced. I want to zoom in, in other markets. So now, obviously, consider the fact that I'm assuming that the crowd that I'm speaking to has a larger than normal risk tolerance. I know I would consider myself. So when we talk about unleveraged portfolios, we kind of groan a little bit and think, well, shoot, even the most conservative amongst us are leveraged 2 to 1, 3 to 1 on down the list. And you can leverage this particular investment 2 to 1, which would have returned 20% this year. You'll also notice, so I just want to point out that since the middle of September to the end of November, when we were going through that really rocky period on the commodity currencies and the yen with the risk crisis, etc., what's going on with bonds? Well, bonds represent a lot of safety. So when the market gets crazy and my site sentiment indicator starts buzzing that I'm losing, readers aren't coming to the site because they're terrified of turning on their computer to see their returns. Well, I've got bonds that are helping to offset a lot of my risk because I'm also participating in that quote unquote safety. Well, at the same time, if bonds aren't performing as well, I'm still yielding a dividend. So it's just one more example of how you can utilize this information. Let me show you another one. I'm going to go to AGG. And the reason why I'm showing two examples of how to use fixed income or bonds is that I find that bonds are probably the thing that most retail investors know the least about. It's surprising actually, but most retail investors I know, they know very little about bonds or how they can invest in them without having to go out and find the actual bond itself and buy it. So the question was, what is IEF? And for that matter, what is AGG? So both of these are stock symbols, by the way. They're ETFs that are listed in the US. That means that essentially what's happening is that there is a company that is buying the bonds, and then they kind of wrap them up in a bundle, and then they sell shares in that bond fund, if you will, under those symbols. So AGG, IEF, those are bond funds. But they're not like a bond mutual fund. An ETF is an exchange traded fund, which means that it's freely trading. You can buy and sell it anytime you want. They generally have lower costs than mutual funds, and it kind of relieves the pressure from you from having to worry about going out and actually acquiring the bond yourself. You can get all the benefits of doing that without having to actually go do it. So both IEF and AGG, the one that we're looking at right now, you can pull them up on any free charting package. So if you go to finance.yahoo.com or whatever, you can pull up both of these stocks, and you can find out a lot more about them. The AGG, by the way, it's a corporate bond fund. So this is an investment grade corporate bond fund, which has really actually, because what's going on in the credit crisis? Who's really getting hurt? Is it Treasuries? Not really. What's happening as the credit crisis takes off is that you've got corporate bonds are getting really volatile, but The other side of that is that even though it's only returned about 1.5% this year, so you can see a very small margin between where it opened the year and where it is right now, it yields around 7.5%. So you apply a little leverage to that, and all of a sudden you've got a serious component and assistance in your portfolio that helps you out. And one thing I would make a point about is that for example, as the market is turning down for bonds in May and June, you have the ability to offset a lot of that risk by looking at uh, other opportunities. So during that same period of time, April, May, June, we've got a pretty good rally in stocks before the adjustment in July. And of course, again, we're forex investors, so we have opportunities there. So I'm gonna close my chart here. There was a whole bunch of others I wanted to show you, but if you're interested in all the symbols I was going to show, just email me and I'll send you a copy of the presentation, and they're all in there. So I'd be happy to share it with you. So let me change my camera here. I'm going to go back to my presentation. Okay, so I'm back on my presentation. And one point that I wanted to make is that as you consider how you can diversify your portfolio, I wouldn't just stick to the way that I view it. I think that a general rule of thumb that I have found to be helpful is that if I can be diversified across 4 to 5 different asset classes, then I get a lot. That's really kind of the optimum benefit that I have found from diversifying my asset allocation. And other classes would include commodities like gold, agricultural commodities, etc., even real estate. And there are ways to invest in real estate through ETFs as well, even private money, if that's something that you're interested in. I'm going to go to my next slide here. The other thing that I would mention is that, and this is, to me, it's very relevant to that part of your portfolio that you're managing discretionary wise. So a lot of the things that I just showed you, the investments that I just showed you, those are a bit more static than we talk about a lot in the Forex. What I mean is, you generally buy a bond fund and kind of hang on to it because what you're really anticipating is that over time the yield pays for itself, and if I'm applying a little bit of leverage, it's okay, and it's a hedge against volatility and in the market in general. It offsets a lot of systemic risk. But within that part of my portfolio that I am using discretion, that I am making trades, how do I treat that? And so this is certainly not a comprehensive discussion on money management or position sizing, but generally the way that people will look at this is they'll say, well, if I'm using money management, if I'm using a portfolio allocation strategy, and I have a section of my portfolio, so let's say within that Forex category, so I have 25% of my portfolio allocated to the Forex and Forex strategies. Well, within that, I have about another 10% or so that's allocated to just be able to take trades when I want to take them. Well, what that does for me is that it makes that very achievable because I know that I can find enough trades to keep my risk very low, but to utilize 10% of my portfolio rather than having to worry about having to use all 100% and taking too much risk. The classic example, of course, is that if we were to run this through a really generic position sizing calculation. So this is something that you've all probably seen 100 times in a row, but it's the way a lot of people, including myself, will size their positions. If I have a strategy that I know I've got a stop loss, or in my case, oftentimes I'll use an option in place of a stop loss or whatever it is, but my maximum loss is 100 pips, that's where my stop is, or my option premium, whatever it is. And I have assets allocated to that strategy of $10,000. So I have total assets available for this particular side of my portfolio of $10,000, and my tolerable drawdown in a single trade is 3%, which is variable. It's whatever suits you, but generally we want to keep that really low. Well, then it's really easy to tell, well, how many positions do we want to open up? Well, in my case, it would be 3 mini contracts. I should probably say 3 mini contracts because it's $10,000 times 3% equals $300. And if I'm basically leveraging 100 pips, so we'd say a pip is worth $1 in this case, 300 divided by 100 is 3. But the important thing is that what I've basically done is I'm able to minimize my risk and get really tight with what I'm willing to invest because I don't have the pressure of the rest of my portfolio bearing down on me. And in addition to not having that pressure, but I have the benefit of having offset a lot of potential risks in this trade by deploying my capital in other markets that are uncorrelated. I have a couple of examples that I'll go through here pretty quick. This is, one of the things that I find a lot of traders do who are really good traders. They're good at finding opportunities, and they're great at entry, and they're even really good at measuring, well, how far do I need to set my stop or whatever it is, but they're really bad at money management because they're having this pressure, so they're investing way too much. Here's an example. I took a really basic technical system and I put it into a system tester just automatically. So this is the equity curve of what that looks like. So it returned 1,347 pips with a 5% max drawdown. So that was the most I was willing to risk in my portfolio. So I upped it from 3%. So not too bad. Here's what it looks like if I up that to a 20% max drawdown, and all that means is I'm not changing my stops, I'm not changing that where I entered the position. What I'm changing is how bad are my losers if I lose. And it's just an illustration of if we have that pressure of an entire portfolio bearing down on us, we might be tempted to leverage too much because it's still a good trade, but not good returns because those drawdowns are too difficult to get over again. Now, so I want to go on to the next technique that before I end my presentation, which is, of those things that we've talked about, that we've gone to diversification, and we talked about diversification as not only a component within an asset class, so diversifying our trades within the Forex, for example, but across asset classes as well. So into bonds, into equities, into commodities, whatever it is that suits you, and even partially into cash on purpose to have a reserve available for you, and margin collateral. But it's also important to understand what am I measuring against? Am I doing any good? I've found that I'll ask traders all the time who are struggling, maybe a little discouraged, and I'll say, well, as you look at your returns, can you tell me if you think you're helping or hurting your portfolio? And which is a bit of a kind of a nonsensical question, because what they struggle with is they're saying, well, compared to what? What would my portfolio would just be sitting there idle if it wasn't if I wasn't doing something with it? Well, not necessarily. I mean, you could always throw your portfolio into something very passive, or turn it over to a manager or what have you. Now, all of us here on this session are probably convinced that by applying our own management, going in and managing our money ourselves, we are helping our portfolio ultimately. But what we have to be able to do is to say, well, okay, but if I get to the point where I start to underperform some of those benchmarks, then I'm hurting my portfolio and I need to take a step back, or I need to consider that perhaps there's an optimal solution out there that does not require me to accumulate trading costs. So here's a couple of examples. I always compare my stock portfolio. I'm kind of oriented towards growth stocks, small cap growth stocks. And I always compare myself against the SPX. So how am I doing versus the S&P 500? Or I manage my own carry trade portfolio, and I always compare myself against a commercially managed, an institutionally managed carry trade portfolio, which is the symbol DBV. I was always measuring, am I doing better? Am I helping or hurting? And there's another way to do this, by the way. I'm going to show you an example, and then I'll give you a reference to some investigation you can do on your own to try to create those benchmarks. And there's actually a speaker here on FX Street frequently that I like to listen to him. He's from FXCM, and he always shows talks about the portfolios that they manage on the Daily FX site, and I always find those very interesting. But I like anybody. I like to look at anybody's strategies, but this will give you a bit of a context to be able to evaluate. Well, how am I doing versus any particular portfolio that's managed out there that I can see? And can I create a common denominator? Can I make a common metric that I can grade myself and them against? Well, one way to do that actually is a Sharpe ratio. And it's named after the guy who invented it, Sharpe. And he's really kind of the father of modern portfolio theory back in the 50s and 60s. And it's essentially a function of what is your excess return? What do you expect to make, or what are you making that's above the risk-free rate? And generally, whenever you're talking about risk-free rate, you're talking about government bonds. Probably the most common is to compare it to the 10-year bond, or the 10-year bond yield in the U.S. And just and then what's the variability of that return? So if you're making 20% more than the risk-free rate, but your drawdowns are 40%, then obviously your variability is very high, and you're taking a lot of risk compared to a portfolio that maybe returns 12 to 14% per year, but has very low variability, maybe 2 or 3%. The Just to give you an example, essentially, if you were to run this, and you could look this up on Wikipedia or whatever and find the actual calculation for Sharpe ratio, but if you were to apply the Sharpe ratio to the S&P 500, which, by the way, you can also get automatic Sharpe ratios from Morningstar.com. The S&P Sharpe ratio is 0.625. Now that doesn't mean anything until you actually compare it. So when I look at my own portfolio, my total portfolio, I have a Sharpe ratio of 1.05. Well, so I know I'm helping. I'm helping my returns. I know I'm doing better than just a generic benchmark, which, by the way, has been a pretty consistent winner for the last 100 years or so. Well, the last since it's been cataloged. So I know I'm doing well, and I can try to maximize that as much as possible. An example, there's an ad on, you can go look at other examples of Sharpe ratios. There's an ad on FX Street for the managed account program, and they'll tell you what their Sharpe ratios are as well. And one of them, I noticed, had a Sharpe ratio of 2.8, so they're outperforming a generic equity benchmark considerably. Now I have to caveat that with it's 1 year's worth of performance, but it is important for you to understand. Well, if I'm going to be a forex investor, can I find comparables out there that I can benchmark myself against and make sure that I am outperforming them? Because if I'm not, perhaps I should push my money into that and take a step back and learn what's going on so that I can understand a little bit better as to how I can outperform, because I know an individual investor can definitely outperform. So this is what I was mentioning to you before. If you were interested in more information about how I personally have a view of portfolio allocation myself, you're welcome to email me and I'll send you this information. This is a more thorough excerpt of how I had allocated this. What I'd wanted to do today was to answer a question that I get a lot in emails and forums, etc. And that is, how do you manage the rest of your money? What do you do with it if you've only got 1 or 2 trades or 3 trades or whatever it is that you're interested in at the moment? What do you do with the rest of your money if you don't want to leverage everything on a single trade? And this is the answer to that question. So I hope that I've introduced you to a few things that you haven't thought about before, as well as a few techniques that you could apply in your own account and investigate further, see if it's something that you would be interested in.